This is Daniela Camboni for Kitco News, and my good friend Adrian Day of Adrian Day Asset Management joins me. He's also a speaker here at the Vancouver Resource Investment Conference. Adrian, always a pleasure to see you.
Well, thank you very much. Always a pleasure to be here.
Now, Adrian, really seems that China is a big topic this year here. It's the focus of the debate between Frank Holmes and Gordon Chang. Is it in a bubble, basically? What are your thoughts on China?
Well, it's natural that we look at China, first of all, because, of course, China has been the driver of the commodity boom for the last 10 years, and frankly, it's the number one factor that's going to determine what the next 10 years look like. China consumes about 40% of most commodities, so it is the biggest factor. I think we sometimes expect too much, shall we say. China's economy has gone from a little over 11% growth to 9% growth. 9% growth is something the rest of the world would be ecstatic about. We can only dream of 9% growth. I was looking at the import numbers recently, and people were saying how imports have collapsed in China. And I looked at the numbers. In November they were up 22% on the year before, and now in December they're only up 11% on the year before, but they're still up on the year before. So I think China is still very, very strong, very powerful. That's not to say there aren't problems with the real estate market, but the real estate market is really the number one negative factor. The rest of the economy, I think, is very sound, very strong.
So if the real estate market is suffering a bit, does that not impact the industrial metals?
Well, it impacts it, but to a much lesser extent than you might think. Remember, in China, most houses are being purchased by wealthier people, and a lot of those houses, about 40%, are being bought 100% cash. There's also restrictions on the leverage that can be used. So that's a completely different situation than the situation, particularly in the United States, where you had people buying houses who simply couldn't afford them, who couldn't even afford an apartment, and people who were buying with no money down. It's a completely different situation. So yes, if there's a crash in the real estate market, it certainly will have an impact, but much less of an impact than did the subprime crisis in the United States. And equally, because there's less leverage, the banks are going to be less affected than were the banks in the United States.
Now, Adrian, you're a speaker here at the show. What was your main message to investors? I know you focused on the resource sector in particular.
Right. Well, resource markets tend to be long. That's the biggest thing I want to get across to people. The shortest copper cycle in the last 250 years was 17 years. This particular cycle started in 2001. So, we're only 11 years into it now. We've completed 10 years of this cycle. The cycles tend to be long, and when you have a new source of demand, whether it's from Britain in 1815 or whether it's from Germany and the United States when they industrialized at the end of the 19th century, these booms go on a long time. Just think back to the commodity cycle. I'm sure you don't remember. From when Germany industrialized and then followed by United States industrializing, the commodities were in an uptrend from 1870 to 1914. That's 45 years of bull market. So I think we've got a lot further to go.
How about the gold stocks? What are your thoughts on that? Adrian, I saw something interesting the other day saying how ETFs may be the reason that gold stocks are suffering.
Well, I think that's certainly one big factor, because for a normal institutional investor, the ETF has meant that he can buy gold instead of doing any analysis on individual companies, looking at all the risks and everything else, the management and everything else. He doesn't have to do that. He simply can buy gold through an ETF. And of course, it becomes a bit of a self-fulfilling prophecy, because the more big investors buy the ETF instead of the gold stocks, then the better gold does relative to the gold stocks, so it becomes self-fulfilling. That's a major factor, but it's not the only factor, of course. The gold companies, I think, to a large extent, haven't really helped investors. They've issued too much stock. They haven't really been very good investments. A lot of the companies really haven't fulfilled what they said they were going to do. Costs have been going up, of course, which isn't their fault, but costs have been going up. But I think one major factor is that they've been issuing too much paper. Obviously, if the amount of paper goes up 50% and you don't have 50% more investors, the stocks go down. But where we are right now, frankly, is I think there's just astonishing buys in the gold sector. And if we have a broad stock market rally, which I'm expecting this year, coupled with gold moving up, then the gold stocks should do very well indeed. I mean, the gold stocks today, the producers are selling at 20-year lows in terms of valuation relative to gold, which is really quite astonishing when you think how well gold is doing.
Sounds promising, Adrian.
Yeah, I think so. And then the juniors, of course, if you have to be more selective, but some of those are just screaming buys in my mind.
Adrian, thank you so much for your thoughts today.
Well, thank you.
And thank you for watching Kitco News. Stay tuned to kitco.com for more coverage from the Vancouver Resource Investment Conference. For Kitco News, I'm Daniela Camboni reporting from Vancouver.